100,000 people in Europe. What the sentiment and the outlook for 23 will be. I know that the Apex report was published last week. I haven't read that, but I think the idea is to get how is the current situation influencing, let's say, the link in Asia Pac and EMEA, and are there any crossovers, downsides, upsides? I think that's the idea for today. So I'm also here with Christiane Conrads. She will introduce herself later. She's leading global real estate ESG for PwC. This is a significant global topic, and I'm delighted to coordinate the real estate teams around the globe for PwC. So I'm just starting with a slide we already have in our report, and that's published for 20 years now. It's a sentiment we ask on business confidence, business profitability, and business headcount. And no surprise, we did this interview in summer. The sentiment, let's say, had a significant discount compared to last year, as we had the Ukraine war especially. Again, this is a European view. Significant drop in business confidence and business profitability. No surprise. I think a comment I would say, if you look at the business headcounts, people are a bit reluctant to reduce headcount because we see the challenge over the last years, and I think it's a general sentiment that the next 10 years it will be a challenge to find the right people. So I think market participants are still reluctant to reduce headcount, even if the outlook for the next year on profitability is significantly more negative than the last years. I think on the key topics, what are the current concerns we've seen? It shouldn't be a big surprise. Of course, in the short term, the outlook for 23 on different topics, but we also asked what's the outlook for the next 3 to 5 years, again, Europe. And as you can see, the inflation, of course, with 91% of participants clearly said it's a big issue for next year. Again, inflation will be high, but in the midterm, as the ECB and other central banks really focused on getting the inflation under control, there was a clear, late, but it was a clear message from ECB to do that. So as you can see, in the midterm, 3 to 5 years, inflation will be handled somehow. That's the general sentiment. If you go further down, the interest rate movement is a big concern, especially on pricing and valuation. We see all this on operating cash flow in real estate companies. It's really a significant issue, and it will remain in the midterm already. A bit reduced from 89% to 73%, but it will be there again, and we have to react on that. We have to reduce price expectations, valuation, and re-engineer our operational efficiency because interest payments will be significantly higher than in the past. And then, of course, we have some concerns about the general economic outlook, more especially in Europe, but also around the globe. The short and the long term, a bit more relaxed on the global outlook on economic growth, but the European economy will go definitely through a significant transformation in the next year, which always comes up with problems, but also comes up with opportunities, of course. And if we asked what would happen if a recession will come up, and I think we are all sure it will come up, so what will be the impact? Definitely the development activity will stop, and I think we have seen that already in the last months, that at least in Europe, more or less all developments that could be stopped were stopped because we had increased construction costs, uncertainty on access prices, uncertainty on financing. That's the key message. Investment volumes are all also down close to zero all around the globe. I think we still see some transactions finalized, which started before the crisis, but new transactions are really struggling as there is no willing seller for the price that the willing bidder is willing to pay. I think that's the message, and driven by, of course, the increase and availability of financing is a big concern also for next year. With the recession coming up, transforming a bit also from the banking balance sheets into debt funds that are more and more coming to the market. There are already some in the market, but there are more and more coming. And again, capital is pulling back. As I already said, for next year we expect financing will be really challenging. Refinancing is a big challenge already. I heard from some bankers already that even in core or senior lending, LTV 50%, some of the borrowers are struggling with operating fully that building in a core location to pay the interest rate, the increased interest rates already from the operating cash flow. So that's even in a core location with an LTV 50, That's something which is new. So it's not just the value, it's also the operating cash flow that we have to focus on. But also new equity, I think there is so much dry powder in the existing funds which has to be invested, which gives me also a bit of comfort in the future that transaction definitely will come back. But of course, in the current situation, new fundraisings are sometimes a bit challenging, at least that's what I hear. I'm looking forward to a discussion also around that, how we see capital on equity and financing side. Important piece of is one question: where do we expect the capital coming from? And as we are here in Singapore today, I think the significant drop, the yellow line is the 2022 numbers, and the blue one is an expectation for next year. So there is a significant drop. I'm really looking forward to the discussion. How is the European capital still motivated to go to Asia Pac and the other way around? So that's, I think, a big topic. That's sentiment analysis, but yeah, I'm looking forward to the discussion around that. And of course, if you look where would I expect invest if I have the options on the table, we see that the, let's say, core investment topics like office and retail is off. Nobody wants to do new investments. We see that something like new energy infrastructure, so solar voltaic things in the buildings are highly on the agenda. Life science is a topic we see quite a while, but it's a niche segment like data center, and the other topics are more around beds and sheds. So all strategies around that, which are seen as a more resilient asset class, but even there we have seen some operating businesses struggling in the past, senior living, student housing. There were some things, but struggling, but we still see it as a safer, or the market participants see it as a safer play compared to the other. For Europe, especially continental Europe, is refurbishment or changing the type of use. So repurposing of assets is a big topic. Also under the ESG regime we see. So we definitely, that's something that will come up, and we see significant, let's say, office buildings that are transformed into residential. Retail assets are transformed into mixed use, and that works well. But it always comes, if you have to invest, it comes with a significant discount on the current valuation, of course, because you have to invest in these buildings. And the top cities we have identified, or clients told us, it's London is back. After Brexit, there was some of discussions, and two of my UK colleagues are here, so so London is still number one, followed by Paris. It's a significant, Paris is a strategic project they are following, so it's pretty positive. And on the other hand, you see some German locations, so not much of a big change, but all locations are on a lower level in general of investment topic. But I think most locations are the same we have seen, but in a different role. And if we ask the clients what are the topics you will see, what will change the industry in the next 20 years, I think we see significant, clear message that it's around ESG, it's about decarbonization, it's about climate change, but I think that's a good topic, and about digitization. But on the ESG topic, I would hand over to Christiane, who can speak much smarter than I can do. Thank you. And looking forward to the discussion.
Thanks, Thomas.
Thank you. Awesome, thank you very much to Apex for hosting us here, for Richard and team for flying with us to Singapore. It's amazing to be here today and to speak about ESG. I'm focusing on ESG for more than 10 years now. Quite honored to lead the global real estate ESG practice at PwC, which is basically an interdisciplinary team consisting of consultants, tax advisors, climate experts, and many more. And we help our clients develop their own ESG strategies and with the various implementation processes. And what we see basically there, so ESG, even though it's, as Thomas said, on top of the agenda, how you approach it is very individual task. So there are no checklists, even despite the various ambitions and projects, and checklists are being developed, and we see more and more consolidation. But I think the first lesson anyone needs to understand is you need to define your own ambition level when it comes to ESG. You need to get to know the regulatory requirements that apply to you. You need to do a thorough stakeholder analysis. and see what your stakeholders expect from you now, but also in the next coming years. And also when speaking about ESG, it's really important to keep in mind that it's a global development, a global transition. So in particular, the physical risks, they don't stop at borders. And what we also see that I mentioned the regulations, that also has an impact on other regions around the world. And we highlighted here, we see many uncertainties right now. Also the crisis in Ukraine, being based in Frankfurt in Europe, it was one of the, it still is one of the biggest topics over the last couple of months. And when the war started, basically at the beginning of this year, we had several discussions where it was okay, so do we need to focus on the war now, the new uncertainty, and less on ESG? And now, 8 months later, saying no, it's more, there's an increased awareness that it's important to get an overview on all the various crises and that they're all interrelated with each other. And I think what we also can say for Europe is so that the war in the Ukraine is basically also a catalyst for renewable energy projects, in particular being based in Germany. Energy independency is one of the bigger concerns right now. Looking at Europe, what's happening there. So mentioned before, so in our international practice at PwC, we do a lot about best practice sharing. We look at other jurisdictions, at other markets, and basically try to figure out what can be used as a template, what best practices can be shared there. And looking at the European Union, we see a very complex and dynamic legislative development following the Sustainable Finance Action Plan. The EU has implemented and is still in the process of implementing various regulations which facilitate environmental standards but also social standards. And when speaking about the European Union, it's really important to keep in mind that it has a very broad understanding of ESG. It's, of course, climate change mitigation, adaptation to climate change is one of the more important topics, but it's also about transition to a circular economy, it's about increasing biodiversity, about water, protection of water and marine resources, and pollution prevention. And at the same time, the EU has a very holistic approach to social standards. You might all have heard about the CSR due diligence code. It's basically a duty of care supply chain act, and we see more and more also whistleblowing regulations here facilitating that human rights, employer rights, but also taxation, fair competition is being maintained in not only in your contractual relationship, but in entire value and supply chains. Basically, looking here, so it started at a rapid pace a few years ago, particularly with the coming into force of the EU taxonomy, which is a classification system which defines when an economic activity can be regarded as being sustainable. And though it's the environmental taxonomy, it's also ensured by the regulation that you need to comply with social minimum safeguards. And whereas we already see the climate-related requirements beginning of next year, we will also see more requirements for the other environmental targets which I mentioned a few minutes ago. And looking at this regulatory process, basically, I think it's about sustainable finance. I would say it's more like a voluntary approach to incentivize capital flows towards more sustainable investments. But at the same time, the EU and its member states are implementing more and more, I like to say, top-down regulatory requirements, which shall facilitate that we reach the targets of the Paris Climate Agreement, but also of the Agenda 2030 of the UN with the Sustainable Development Goals. And as a consequence, we see a lot of many investors, many clients have to face a lot of uncertainties. We see unclear provisions, and not all the regulations are harmonized with each other. I mentioned to you, Eric, before, we spent a lot of time this summer comparing the various EPC requirements all over Europe. But that's something we just have to do, and I think the next coming years will provide more clarity here. Last but not least, I'd like to mention the EU is also facilitating the sustainability reporting. So coming rather quickly from 2024, the sustainability reporting will have the same importance, same as financial reporting. And that's something which is also unique data. You need to be prepared for that. That's also something which causes a lot of disruption in the European market, but also for companies doing business with European countries. So, and I'm very, very grateful to be in Singapore here. So I mentioned before, ESG is a global topic, and what is really, it's such a broad topic, and not one country, not one market is kind of leading the games, but it's about collaboration, it's about best practice sharing, and we're currently conducting a study for the ULI, a regulatory mapping exercise of ESG, and one quote there was, collaboration is the new competition. And that's basically what's so important, and I think many in the industry have started to acknowledge that, and started to jointly develop environmental and social concepts. And looking at Singapore, I think I'm super impressed by the approaches in Singapore when it comes to biodiversity. It's already started the project that Singapore shall be transformed into a city in a garden. It started already in '63, but over the last few years it has really gained in importance. And look at the various activities in Singapore. You see that a lot about green areas, green facades, like the Oasia Hotel, also the PwC office with its garden inside. And what I think is really important here to keep in mind, it's what I said before, all the various crises and topics are interrelated with each other. And when it comes to biodiversity, we won't have climate change mitigation without a high degree of biodiversity. So that's something which is necessary for climate protection, but also for climate change adaptation. So what's really, with the green facades, for example, learned that it helps cooling down the facades of the properties extremely, I think by 30 degrees, then you need less energy for the air conditioning inside. And this also has a beneficial impact on the environment, the neighboring adjacent buildings as well. And not at least, one topic which I find very interesting is also that the combination of roof gardens together with photovoltaic power plants increases the efficiency of photovoltaic power plants due to the lower temperatures. So that's all something, which is very interesting, very complex, as I said before, knowledge sharing is the thing to do. And with this, basically, I hope I gave you a bit food for thought and also for the discussion later. And thank you very much. And back to you, Richard.
Great. Thank you, Christiana. Grab a seat, Christiana, and Thomas, and other speakers. If you come up and take a seat, that would be great. Really interesting, and I think that knowledge sharing part of it it's a random seating arrangement. You can sit wherever you choose. I think lots of interesting points to come out of that we can pick up And one of the things that we're focused on, although we do cover the news, obviously, because there's an interest in that, a lot of what we're covering on a sort of day-to-day basis is research, strategy, thought leadership, what people are thinking about, because that tends to drive the news in the next months, rather than dealing with that there. So, quick introduction from you, Alex, just on yourself and the company. We'll work our way around, and then everybody will know everybody else here. Alex.
Sure, thank you, Richard. Hello, everyone. I'm Alex Jeffrey. I work for Savills Investment Management. I'm responsible for our real estate investment business globally. We invest in real estate in equity and debt across Europe and Asia. Actually, the majority of our assets and people are actually in Europe. But I'm based in Asia, in part because we see significant opportunities to grow business and invest with clients in this region, and also help Asian clients invest in other regions. We invest in all sectors. We have offices, 17 offices in 14 different countries. We've particularly focused recently on the logistics sector. We have a big portfolio in Europe, and as well as residential, and as I say, debt.
Great, very good. And it's going to be interesting to get that sort of global perspective as well, I think, there. Good, David, thank you.
Hello everyone, David Edwards from DWS. DWS is a global investment manager. I am a portfolio manager in the company looking after a Pan-Asia core fund.
Super, Christiana. You.
Yeah, as I said before, Christiane Konrad, I run the global real estate ESG practice at PwC. Looking forward to the discussion.
Perfect. Eric.
Thank you. My name is Eric Chia. I represent Union Investment Real Estate. I head up their investment business for the region. It's a group that is larger. As part of the group, there are other asset classes which include bonds, fixed income. It's an AUM of about 450 billion euros. Global in terms of its appetite to invest, and this region, Asia Pacific, is one of the key areas that we want to grow.
Great, and Valerie, and thanks very much from me for hosting as well. Thank you.
Valerie Mentos. I'm the head of ASEAN for Apex, which is a global asset servicing firm. We are covering 55 countries, markets, and we are working with real estate developers, real estate managers, real estate investors on the entire cycle of the real estate investments. Asia is a strong market for us. It's one of the key markets. We have more than 9 offices in Asia, and we have an AUA of $3 trillion US dollar globally.
Yeah, quick again. Yeah, Thomas, I'm a partner at PwC, located in Frankfurt in Germany, leading the global industry real estate, and from my history, I'm a deals person, so worked on all equity, debt transaction, restructurings, non-performing loan portfolio, whatever we saw in the last 25 years in the market. I'm looking forward to the discussion.
Let's just maybe start with you, Alex. We went through some of the things there in Thomas and Christiana's presentation. I suppose, what are you seeing as some of the sort of key elements for 2023 that you're having to think about in terms of the drivers for your business?
Thank you. Yeah, I mean, I identify with a very, comprehensive list of topics in Thomas and Christiana's presentation. I think, Christiana, you mentioned that there are many crises that are all interlinked. I saw it being described, I think, yesterday as a poly-crisis. Because these are all individual crises, but they are all interlinked, interwoven, and it's probably one of the most complex pictures that we've seen for many years. As you try and forecast ahead and see what GDP growth is going to be, what inflation is going to be, interest rates, and it's almost impossible. I think we should really be kind of humble and honest that it's almost impossible to make those forecasts, and therefore, because you could say that there's going to be a recovery in the second half of next year, but we don't really know, let's face it. And so our view is that investors should probably look at the long term and look at the aspects of real estate that have fundamental supply-demand dynamics that are positive. And there are quite a lot of those aspects. And I think there will be pain over the next couple of years. That's undoubtedly the case, because equity real estate is generally negatively correlated to rising interest rates in terms of valuations and returns. So those supply-demand imbalances, which are quite extreme in many cases and will persist for a very long time, we think, can be quite compelling. Not in every country or every sector, but I think that will be the interesting topic for discussion. I particularly focus on debt because, as Thomas pointed out, the refinancing challenge is dramatic in Europe in particular, and in the US actually over the next 3-4 years. And I do think that banks will pull back, either under pressure from their shareholders or from regulators, and the opportunity for non-bank lenders will continue to increase because people will need to meet this refinancing gap as LTVs come down. And that's an interesting opportunity for investors because we typically see after a crisis that spreads increase and risk-adjusted returns on debt can be quite attractive.
That's interesting, and I'll pick up on that point about debt in a little while as well. We had a focus session on the outlook for debt 2 weeks ago in Frankfurt, so it'd be interesting to see, whether there's a sense of a difference here between, what's happening in Asia and Europe. David, just coming to you, I suppose, what are you seeing? Thomas mentioned there about resilience in terms of the different sectors, that there was a big focus on anything to do with beds and sheds, logistics, living. Is that what you're seeing here in Asia, or are you seeing a different set of, kind of investor intentions?
It's an interesting question. So, beds and sheds is a theme, but the residential markets in Asia-Pac, ex-Japan, multifamily really isn't accessible. So it's a theoretical construct for most of the region. It's being built in Australia, to some extent, in New Zealand. Koreans are talking about it, Chinese are talking about it. But that's sort of opportunistic, and I think getting debt to do that in the current market is quite a challenge. But if you want to buy the standing residential assets, Japan is pretty much your only market, and given that interest rates haven't risen in Japan, you can still get a good spread, but it's off low levels. The residential yields in Japan are high 2s, low 3s. So no one's getting fat and rich off that sector. I think logistics has been obviously a favoured sector for several years. That was a thematic that existed long before the wars in Europe. I think that still has legs as a theme, but pricing has changed. Yields have compressed significantly, and I can't see them compressing any further. If anything, they may expand, particularly in markets where interest rates have increased more dramatically. We're not seeing much by way of repricing, but we are seeing construction stop. If you want to construct a warehouse in South Korea today, then if you can get debt at all, it's likely to be very high single-digit or double-digit for construction. So that's fairly prohibitive, and construction projects have stopped in the logistics markets. I think, just stepping back a little more broadly, certainly from colleagues in Europe, we know that the office sector is highly challenged in Europe. Perhaps less so in this region. In North Asia, not many people work from home. Culturally, that wasn't a thing. If you work for a mid-sized Japanese company or you're in a company, if you're not in the office, you might not have a job anymore. So the office occupancies, physical occupancies, have held up much better in those two markets. I think in Australia it actually depends city by city. Melbourne city centre is still really quite sparsely populated because Melbourne had much more significant shutdowns. But Brisbane and Sydney are back in business, and I think Australia's seen repricing of office assets more quickly than most other markets. So there's an opportunity there that says if values are 15-20% cheaper, maybe that's an investment opportunity in the office space, particularly if you're able to get an asset that checks all the ESG boxes, perhaps is particularly where sort of the physical real estate has a lifestyle or some people are using the word service, but it's the experience. If you could check that box as well, that space is attracting the tenants.
Okay, good. I'm going to come back to that office sector in a minute because there are interesting differences as well, particularly if you look across Europe. London, for example, where the sort of work from home element has been much more significant than areas in Poland, for example. Paris as well has, so there are slight differences there. Valerie, I just wanted to pick up on, in terms of the capital flows, what are you seeing there? Are you seeing, Thomas mentioned there, what are we likely to see in terms of capital flows between Asia, Europe, Asia? I suppose, are you beginning to see any sort of patterns emerging or what you're expecting in 2023?
Yes, it's very interesting because I think there have been, in terms of capital flow, a pre-COVID, a post-COVID, and obviously the challenges that Alex mentioned. So I would say the last 2 or 3 years have still shown that there is more inbound, so money coming outside of Asia to Asia than the other way around. And when we think about inbound, in particular North America, so they are still the leaders in terms of injecting capital in real estate in Asia. They have been doing it for a few years and they just continue. On the European side, there have been a drop of capital injection in real estate from what we see again. And the capital injection from Europe would be a much more sector and geographical focus than the one from North America. And why? Because most of the capital coming from Europe would be institutional capital, with a risk appetite slightly lower than the pool of money coming from North America. So the usual suspect or the usual market benefiting from European capital would be Japan, Australia. Not anymore China, as you may imagine. But as I mentioned, from North America perspective, it's a bit more diverse. So you would see obviously Japan, Australia, Korea, but also ASEAN benefiting from this capital. India is another one. And it's one which is becoming more and more interesting because they managed to attract the capital which was initially targeting China and which is now going through India. In terms of outbound, so in terms of capital from Asia to the rest of the world, again, they have been pre and post-COVID. So pre-COVID was mostly Europe and US. During COVID, because of various restrictions, there have been more regional to the allocation of Asian capital. So we've seen more activity between regions in Asia, between countries in Asia. We've started to see again the US benefiting from this outbound or outflow of capital, but I think the regional one is an interesting trend and we expect it to continue.
Okay, good. Eric, I just wanted to pick up with you. You're obviously Union Investment representing, German capital to a larger degree, but obviously capital raising around the world. I suppose, what are you seeing? Have you seen any change in terms of either the volume of capital or the interest from those capital sources that you're seeing coming through, particularly looking at the Asian market?
Great question. One is, I suppose, just to frame it, the capital that we're looking for more core investment. So more yield base is one sort of point of difference. And then I think where you're coming from is also from the perspective of the geographic focus as well. I think one is, if you take a step back, if you actually put your money in the bank right now, you're actually getting an interest rate. If you buy a bond, you're actually getting more of a yield than you did before. So that idea of the reallocation of capital is actually taking place. People have choices when they're actually putting their money to use. So I think that kind of environment is already like one distinctive change that's taking place. So that can sort of reshape how the pressure of that capital is coming towards like this region. I think then if you sort of step back and you look sort of more for strategic reasons, the idea of diversification still exists, the idea of having a lower correlation relative to your home market still exists. People want to take the benefit of that. So that'll also like draw. And then I think if you get to be able to tell a deeper story, it's about sort of then starting to trying to separate the ideas of what's happening operationally in terms of the fundamentals, what's happening in terms of the capital markets as well, like in terms of things that might influence like debt as well. So once you sort of start painting the picture, and you can actually tell the story for this region. So I'm actually come to the point where I think there's more reason for optimism in this region. And it's not that we are immune to inflationary pressures, it's just that we can be like less exposed to the same pressures that are either in Europe or like in the US as well. So having that sort of that lower exposure, then actually there's potentially more reason to be more optimistic in this region. And then that's where you start to go deeper. And I think to benefit from that optimism and really to look at what's actually happening from that operation. I think that's where you need to slice the discussion. Because at the operational level, if we go by sector, if we go by geography, we'll find even better stories to tell. And it's even interesting things like you mentioned before, David, about the office market, the characteristics of how the office market works here, they're quite different as well. Logistics, again, I think, because when you're looking at the income, it's about the potential for that growth in that income. Can you find it? And if you can find it, that's where you keep on focusing on. That's probably the pathway that I would sort of suggest.
Okay, good.
Sorry.
Yeah, go ahead.
I would actually agree in terms of opportunities and really optimistic mindset here in Asia. When I think one of you mentioned that the activity, investment activity in Europe was in some countries close to zero. In Asia, when you compare to a year ago, it's 20% less, but still it's 20% less. We have some activities. It's more about resilience and patience. So capital is not deployed as fast as before, but we know that it will be deployed. So it's slightly different.
There's an interesting thing as well. So distance. So for example, when we're talking to people who are in, let's say, Spain or Portugal, they will be saying that their market is much better because it's much further away than Central and Eastern Europe from the war in Ukraine, for example. So it would be interesting just to get a sense of how people are seeing the fact that there is a war in Ukraine. Does that influence much more investment at the moment in Europe, or the perception of it? Or is it just different because everybody is so much further away here, in a sense? I don't know, does anybody have a view on what they're seeing, how the perspective is from institutional capital, particularly looking at Europe at the moment?
When it comes to Europe, I would say that there is definitely a geographical aspect to it in part. I mean, I was in Warsaw in our office there about 3 weeks ago, and I have to say that whilst the economy itself is still chugging along, and and Central and Eastern Europe has been quite resilient in previous downturns, it does feel very, very close, and there is a complete stop of transactions. Speak to international investors, many of them will simply not invest in Central and Eastern Europe at the moment. I'm not saying that that's a long-term effect. But I think for the rest of Europe, people look at it more on a sectoral basis, I would say. And some of the trends that have been mentioned are certainly at play. I mean, look, we're focused on a pan-European level, in particular in logistics and industrial sector, but in urban locations, because there's a huge pressure on land in most major metropolitan districts in Europe, particularly Western and Northern Europe. That's the case in the UK and Paris and Germany, where there's been a constant process of urbanisation which continues, but government's priority and local government's priority is often to create additional residential because, of course, there has been consistently increasing house prices and problems with affordability, especially for young people. And so a lot of that land is taken for residential development and to protect the green belt often in many countries, often quite rightly. And so the pressure, if you take London as an example, Greater London, between 2001 and 2015, there was an 18% increase in population, largely because of immigration and urbanization. But a 15% reduction in available land for industrial use. And that, probably better statistics are available in the UK, but if you were to find that in most other metropolitan districts in Europe, we would say the similar picture applies. So long-term supply-demand fundamentals in industrial use and logistics, last mile delivery, for example. And of course, a lot of that stock that exists today is very old. 50% of it, I think, in the UK is industrial stock is over 20 years old, and you'll probably find that in many other European countries as well. And therefore, it doesn't meet the EPC requirements, the ESG requirements, and of course, you've got the continuing trend of online retailing. So many different trends are converging to provide a long-term positive trend on industrial. That's just to pick one. And I think that's a pan-European thing, which generally, obviously there are regional variations, but this relates more at a city level. The major cities are experiencing this. And for similar reasons, rented residential is emerging as well. Not an asset class that many institutions looking at Europe have focused on in the past. I know that's different in Germany, different in Denmark and so on, but by and large, it hasn't been an investable asset class compared to, say, the US. And that's something where, again, there's a very compelling long-term supply-demand imbalance in place. Largely we look at that as on a pan-European level, but obviously in finding the opportunities, it's a very local thing. You need to have it on the ground.
Yep.
One or two comments from pure German perspective, and I agree to most of that, but the question we get for investing in Germany from international clients, could be from North America, could be from Asia Pac, is yes, Germany for us is still on the agenda, but first of all, we want to understand how you can tackle and solve this energy problem, because we are heavily exposed to the Russian gas. And I think there are some measures in place yet, but there's no final solution. I think we will get, the winter will be okay, hopefully this year, but the challenge comes especially for next year. So that's the question. If we can show a clear roadmap how we solve these things, I think then the doors open again for significant capital flows into Germany. At least that's an argument currently here, specifically in Germany. It might be relevant for whole Europe, but specifically in Germany, and I do most of the discussions with investments into Germany. And the second topic is German investors currently are not doing new investment. They're pretty reluctant. That's why fundraising is difficult. But as I see the trend, capital is there, and lots of investors now refocus on the asset management. They say, yes, I have the money and I want to invest, but not in new properties. I more invest into the renovation, putting my existing asset in a more resilient position, doing the ESG transformation, putting in the smart metering technology to transform the asset. And these are significant amounts, partly, and that's where I currently see the focus, at least, of the investors that already sit on the assets and have capital that they can allocate into this transformation. And that's really sometimes significant amounts. Could be 10, could be 30, 50, up to 50% of the current asset value. Just to bring their current asset in a position to come back out of this crisis with a significant value increase.
And it'd be interesting, maybe pick up your views on that, Christiana, as well. But so in the session that we had around debt, there was also a view that because you've got, particularly in Europe, with the change in terms of financing and making, debt an issue, certainly if you're coming up for refinancing, that investors and asset owners may look at it and say, okay, look, we're going to have an issue with this asset anyway in the next 5 or 10 years in terms of sustainability. Whilst we've got a problem with it, why don't we solve it all in one go? So do you think that this sort of one of the poly crises that we've got, do you think that will actually be a bit more of a driver for transformation, in a sense that it's actually going to force this issue a little more?
Yes, definitely. But we also see, also speaking about transactions, I think what Thomas just said is right. We see that's so many asset managers and investors trying to reconsider their strategy. They look at the existing building stock and see what they can do to make it more energy efficient, but also to implement a comprehensive ESG strategy. But doing it in one go is almost impossible. That takes years of know-how building, and I think, and you don't know if also trial and error approach is something. I understand you do that, have been doing it for many years. Something is good, but that's also very expensive as well. You don't know if the solution you decide for today is going to be the one which will be still good enough in a couple of years. And I think looking at the market, what we really see is a changed stakeholder sentiment. So from the occupiers, particularly from the corporate occupiers. I got a call from a project developer of office core properties in Germany, and he let me say, my buildings are old, they are outdated before they've even been completed. And they comply with the regulation, but the users, the tenants don't want them anymore. And looking at the tenants' demands, they vary extremely from tenant to tenant. One tenant wants a net zero building, which was also constructed in a net zero way. The next tenant wants that the other tenants don't have an exposure to fossil fuels. And so it's something to keep in mind. So your building needs to be good enough, the next few years, but also looking at future requirements, future stakeholder demands needs to be good for the next 10, 15, 20 years.
Yeah, and there's definitely a focus on that embodied carbon in Europe for certain. Pick that up, Eric.
Yeah, I'd like to pick on that because I think there's, just to provide the practical insight into it. So if you've got a portfolio that is 50 billion euros, 100 billion euros, what's step one? Step one is to measure your portfolio. Then after you measure 50 billion or 100 billion in that portfolio, where are you performing? Then the next thing is to benchmark that portfolio. Then after you benchmark, then you've got to work out where do you sit relative to that benchmark. And then what's the plan, and then you've got to execute. So that's where there's this journey from. And there's a group of very talented people that are all in our organizations that, if you saw the time chart that Christiana had, it started in 2021. So they've had that time, whereas before that, they didn't have this job. They've got this new job that they have to do right now. So their project managers, the technical guys are super busy. And then you've got fund managers who are now looking at the overall performance of the fund relative to the target. And it's kind of like averaging a little bit low. They need to bring that average up. So that's kind of the journey going forward. If someone brings like a bright, intelligent investment manager comes and like, I've got this great idea. Here's this investment. What do you think? And they go, well, that's just extra work for me. Can you give me something that's a little greener? That's kind of the dialogue that's present today. And I think the one that sort of scared me more is when Christiana was talking about audit. Because once you have audit involved, that pressure just went elevated to get this done. It's time, it's what are you doing in that time frame. So it's a big journey there.
Okay, good. Maybe just picking up with you, David, are you seeing the same, you mentioned there the office, are you seeing the same in terms of corporate occupiers, that demand for a space that is very sustainable? What's the drive like here in Asia, for example?
It varies a lot by market and by individual company. And you sometimes can't get all of those people to agree on which horizon the sun will rise in terms of what do they all want from the ESG perspective. In Australia, it's been a significant issue for a long time because the government has set standards for their own occupation. So corporates definitely don't want to be worse buildings and it's the government standard. Similarly, New Zealand. But again, if I go back to that mid-sized Japanese company, don't really care. A mid-sized Japanese building rarely has a rating. And when you propose that, you get some quite strange rules. It doesn't mean we shouldn't do it, it means that you need to lead, but it's quite different in the different markets. I think in the bigger financial centres, the companies are all global. So, also I shouldn't say they're not all global, but many of the companies, many of the major corporate occupiers are global or at least regional, so they have standards that they've rolled out. Because they're meeting the same requirements, whether it's European standards or US standards or APAC standards. So there's a lot of similarities, but there are differences on margin.
Yeah, I mean, on the topic, Asia is indeed really fragmented because there are, in a number of Asian countries, no prescriptive regulatory or government requirements on sustainability. So at the end, as you said, it's just decided at the level of the corporation, the asset managers. It's really driven by the private market, and which then, in terms of sustainability journey that you refer to, will be a challenge because if it's left at the level of the private market, you will have certain countries going faster than others, but also the benchmarking will not be possible. So you will not have enough stakeholders, you will not have enough qualitative data to be able to do any benchmarking.
Okay, good. I wanted to pick up a little bit on something you said earlier, actually, Eric, which was also about institutional capital having other opportunities in a way, which is if you're comparing real estate then with bonds, for example, or equities, you may then begin to think, well, actually, is my risk now being fully paid off? So is there a danger of some kind of denominator effect there where investors then go, okay, well, I'm not really getting the return that I'm looking for, so therefore I'm going to, instead of putting my capital here, I'm going to move it into bonds here. Is that potentially a challenge for 2023, do you think?
It's a challenge for 2022.
Okay.
So I think there's two parts to it. The denominator effect, I guess, is when you've got that broader allocation across other asset classes. When some have devalued already, that's elevated the weightage of the real estate composition. So that's already taken place, and that's also kept some investors from investing right now. Then you've got also, you're right, there's just a better choice in terms of return. There's two parts to that. One is it's still that allocation story. You still believe that you should have a certain level of allocation to real estate. That'll help preserve some of that allocation towards real estate. But then, that return that you do offer, there'll be it's a competition for that kind of that return that's coming forward. And that's where you've seen it's actually played out, and I guess this is a comment about the Australian market where it's done quickly played out. You look at the deals that have gone to the market in recent weeks, where either the deal has been pulled from the market, or there's been 100 basis point separation in terms of what the vendor thought they might like to get and what the buyers are sort of making their offers for as well. So it's starting to translate now in this region.
Okay, good. It'd be interesting to get a sense as well of where we think in terms of which types of capital is going to be more successful in the current market. Is it going to be longer term patient capital? Is it going to be those that are really looking at using equity, therefore don't need any debt requirement? Or like you mentioned, Alex, are we going to see increasingly maybe more of that capital moving into the sort of debt fund side of it? So it'd be interesting just to get a sense of what people are seeing in terms of that capital raising side. What is gaining traction and what is not?
Yeah, absolutely. Just picking up on Eric's point, the denominator effect is definitely in play. I mean, it's not something we've heard about for probably 10 years, but it's come back, and due to the profound falls in the other asset classes. And then there's actually a numerator effect as well, because real estate has done quite well. And as it, particularly in 2021, was a very strong year of recovery after the pandemic. And asset values in various parts of the world continue to grow, actually, in 2022 as well, maybe in the first part of the year. So I do think there's a survey done every year, you may see, by Hodis Weil and the Cornell University.
Yeah.
And, it's really interesting to look at that, because one interesting trend that they picked up, I think they've been doing for 10 years, is that target allocations to real estate have fairly consistently increased year on year by about 10 basis points. And I think they're now sort of 10.4% or something like that on average. And for most of that time, there's been quite a gap between people's actual allocation and the target allocation, usually between 1 and 2% around the world, which is obviously quite a very significant number of potential investment when you add it all up. But now, for the first time, I think they were saying a third of institutions are over-allocated because of this denominator effect. And that survey was done in the summer. And actually, the people that answered the survey towards the end of the period, more than half of them were over-allocated. So this is leading to quite a significant slowdown in liquidity, and that would persist, I would suggest. So when we go around talking to our clients and potential clients, this is what we pick up. I mean, that's the first thing. I mean, the average institution would be saying, I'm sitting on the sidelines. Partly because of the denominator effect, partly because of other opportunities to invest in fixed income perceived to be lower risk asset classes, but also just generally the worry about how on earth do you sort out this polycrisis ahead of us. And I think people are saying, well, let's wait until next year, maybe even the second part of next year, before we make any decisions. If people are interested in anything, what we are seeing is certainly an interest in debt, because I think there is a perception that, at least in the short term, debt returns should be more positively correlated to increasing interest rates because of the interest rate itself that you can charge, but also because spreads above that interest rate tend to increase in periods of crisis and post-crisis as well. But also we see interest in this region from Europe and North America because, as Eric was saying, it's perceived to have slightly more resilient qualities. Perhaps inflation pressures are less acute here, and interest rates therefore will maybe not peak at such a high level. And then within Asia Pacific, obviously it's a huge region with lots of different countries at different stages of the cycle. Probably Japan would be the one that people would focus on and say, well, that's at the moment, who knows how long it will last, but at the moment a rather special case because inflation doesn't appear to be particularly elevated, and the central bank is taking the view that there are no long-term inflationary pressures, and therefore they're keeping interest rates at extremely low levels and continuing to manage the yield curve in the way that they have for many years. And we don't see that changing even after the governor of the Bank of Japan changes in the spring next year. And as a result, therefore, sentiment in Japan seems to be more positive. There is, however, a problem of liquidity, so you're not necessarily seeing the valuation falls yet in Japan, but you are seeing a significant slowdown in liquidity, so far less buyers for each asset.
I just wanted to very quickly just fire through some of the opportunities. Big focus at the moment, particularly in Europe, but I'm assuming around the world as well in terms of life sciences, science, technology, some of those alternative areas like data centers, a big focus on those in general in terms of investor intentions. Is that the same also here in Asia? What are we seeing?
I think it depends on the investor. So data centers in Asia Pac are rarely on a triple net basis. So if you are owning the tech as well as the building, the tech is usually 2/3 of that sum. So actually that's really infrastructure. It's not really real estate. And I think investors are starting to sort of make that differentiation. You do occasionally see a triple net data center out of Australia, but it's actually rare in the region. So I think life sciences, medical office, again, deals are sparse, so it's not a big part of the universe. So I think those themes are being looked at, but it really can't be the base of what you're doing, because the deals just aren't there. You're not going to deploy that. So I think, it does depend by investors, but it's about the scale of the opportunity as well.
Okay, good. It was very bold to attempt to do Asia and Europe in an hour. So, but it would be good just to get a sort of last view, I suppose, from everybody on where you do see the opportunities at the moment. So I suppose just pick on a key trend and a key opportunity for 2023. Let's start with you, Thomas, and work our way to Alex at the end.
I would clearly bet on the transformational innovation part. So I would say manage the green strategies, whatever it exactly calls, and have a look on the PropTech scene. They're struggling currently, but we need innovation. There's so much smart people starting their own entities in the PropTech space, and that's, I think, the two areas I would focus on.
Okay, great. Valerie.
Thank you. I would say digitalization, technology, and through that, democratization of the access of real assets, not only real estate, so tokenization of real estate funds and all type of use of tech to bring different source of capital to the real assets.
Great. Eric.
I think we've gone into more of a risk-off sort of mindset, but at the same time, I think there's a lot of optimism for Asia Pacific. But keeping that in mind, to go back to more of an old school real estate approach, then I'll just go back to office and logistics, and I'll probably pick a career in Australia.
Okay.
I think there will be a lot of focus on the functions building can possibly have. So using buildings also as carbon sinks, as local farms. That's something where I expect we're going to see a lot of innovation.
Super.
Well, we haven't talked about capital flows Asia to Asia. And many Asian investors had institutional investors had little or no allocation to real estate, so they don't have that denominator effect. They felt the pain across the other markets, but not the denominator effect. So I think that's one interesting to watch, and I think it's been gathering a bit of steam during the pandemic as well as sort of post. I think ESG is obviously a hot topic. I think the wild card there is, people look at their GRESB score, and if they are perceiving capital requirements, maybe just get rid of that underperforming asset, because that'll push your GRESB score up. At the moment, GRESB is not doing apples with apples comparisons. So buying an underperforming building can bring your score down, and some funds just won't do that. I think we need to look at that as an industry, because we shouldn't let all the old buildings go defunct and become stranded, because rebuilding them is the worst thing we can do from a carbon perspective. So we need to find ways of doing that. But I think you may see more motivated sellers of buildings that are at the lower end of their ESG scores, and that's where you get the discounted pricing in the market, and that can then trigger more sort of activity from an investment perspective. So those are things I've been watching for.
Yeah, and I noticed actually that MSCI had some figures out. Certainly, this was London and Paris, but showing an increasing, gap between sustainable office, particularly, and more brown office. So that gap beginning to widen, really. Alex.
Yeah, I totally agree with what David just said about GRESB and also Christiane. I think you mentioned that collaboration is the new competition. Is that what you said? Yeah. I must say I absolutely identify with that, because we see many colleagues across the industry, proclaiming GRESB scores and other kind of green ratings being the top in the industry. And I'm really not sure that that's the right way to tackle this problem. It's a shared problem, and we all need to share best practice, really. And if to get your GRESB score up, you don't buy brown assets or you sell your brown assets, that's not really achieving anything, is it? And you're often going to be selling it to somebody who's less responsible than you are. So I think, and also the data point, absolutely. I mean, MSCI, I saw that, and I think they were saying that, a green certified office over the last, 7 years, the sales have been an average of 132 euros per square foot. I'm mixing currencies and measurements there, but the non-certified ones were 102 or something like that. So, but the trouble is, you can't necessarily say that that's all because of the green certification. There could be other points at play, but the point about metrics is really important, because it always used to be that if you invest responsibly, there's a trade-off with your returns, and what return are you going to give up in order to make a building green? Well, the more and more evidence we get on that front, the better, because we can then demonstrate that actually this is in line with investors' desire for better and better financial returns. Anyway, sorry, going back to your point, what are the big opportunities? Well, on the debt side, as I've said, I do think the refinancing challenge will be huge for many borrowers that have existing lending positions, that own assets, and they've got existing indebtedness. And therefore, anyone who's able to step in and provide debt, or even equity, to buy those assets out of distress at a discount, will have a big opportunity in the next 2 or 3 years in Europe, perhaps less so in Asia. On the equity side, I'll be a bit contrarian maybe. I actually think retail has got some really interesting opportunities because it took its pain. And many of these assets are at really bargain basement prices. Across Europe and Asia, actually, we've been buying in Australia. But not all retail is the same. It's the more non-discretionary parts of it that we would go for. Food stores and the food-anchored neighbourhood retail store centres, where you're buying at a much higher yield, and therefore you're protected a lot, because a lot of more of your return is coming from income.